Hello and a great welcome. So starting in this particular session, we are going to a very simple standard, in fact deals with valuation of inventories. But before we outset and start discussing the various guidelines of this particular standard, let me actually just explain 2-3 points. We are doing valuation of inventories. And once again, as I keep on saying, that we are trying to actually kill two birds with one stone, because in this particular standard, both AS2 and Ind AS2 will be covered well and truly. The reason being is very simple, because guidelines of both Ind AS2 and AS2 are absolutely same. I hope you got the point. So here we go, and we come directly to the point. But as you know, actually this particular standard happens to be pretty easy, and you are very well familiar with all the aspects of this particular standard. We will see that this particular standard deals with what we call valuation of inventories. No doubt about that. It deals with at what amount the inventories need to be carried in the financial statement. And you and I both are very well aware of this particular fact also, that inventories are carried at lower value between the cost and the net realizable value. Correct? So basically the standard deals with the carrying amount of the inventory which need to be reflected in the financial statements of the inventory. Standard is very, very significant in the sense that inventory valuation, as we know, inventories are reflected both in the statement of P&L and also in the balance sheet. So it influences and impacts what we call not only profit and loss account but the balance sheet. So the valuation need to be done absolutely correctly. So here we go, and just have a look. I have already written you. I'm not going to write in front of you today. The reason being, especially in this particular session, reason being is that initial part is very simple, and the normal things which we have written. First thing, I have already told you that standard deals with what we call valuation of inventories. And of course, the objective I have already told you, the main objective of the standard is determination of the carrying amount of the inventory in the financial statement. In order to know what amount will be reflected in the financial statement, we will have to compute the cost, we will have to compare it with the NRV. So that is why I have also written that in order to know the carrying amount, it encompasses. That means in order to know the carrying amount, we need to determine the cost of the inventory and the amount written off to bring it to its NRV. Correct? Suppose the cost is 1 lakh and NRV is 90,000. So we have to subtract 10,000 from the cost to bring it to what we call NRV. Correct? Standard is significant, as I just told you a moment, because it impacts both the statement of profit and loss account and the balance sheet. Of course, which are the areas where this particular standard will not apply? This particular standard will not apply, of course, to any work in progress which arises due to what we call construction contract. Similarly, this particular standard will not apply to any work in progress of the service provider. Suppose I have taken some services from a service provider, and contractually, he is supposed to give me, let us say, 1 lakh worth of services. 25,000 worth of services he has already delivered me, and 25,000 worth of services are in the pipeline. That is exactly the work in progress of the service provider. But this particular standard AS2, or for that instance Ind AS2, is not going to apply over here. Correct? Because there are separate standards for the same. Similarly, this particular standard will also not apply to any shares or bonds or the financial instruments which are held by an entity as stock in trade. Similarly, this particular standard will also not apply to the producer's inventories, like livestock, you can say, like agricultural assets, you can say, like forest products, you can say, like mineral oils or ores or gases, because there are separate standards for the same. Of course, now the main point is what exactly the inventories are. You are very well familiar with the definition of the inventories. Just to recap the things, inventories are, in simple words, some assets which are held by an enterprise. Held by an enterprise for what? Correct? For the purpose of sale. So if I have held some assets, inventories are assets held by an entity for the purpose of what we call sale. Now, could you give me some example? Let us finished goods. Now, finished goods are held by an enterprises. Of course, these are meant for sale. So that is why it is written over here that inventories are asset held for sale in the ordinary course of the business, of course, and the example I have written also finished goods. Similarly, what we call inventories are assets in the form of work in progress. Work in progress means such assets which are in the process of production. So there might be what we call some assets which are still in the pipeline, which are still in the process of the production. So generally we refer to them as work in progress. Correct? So inventories are asset held by an enterprise either for sale or which are in the process of the production, that is work in progress, or which are meant for consumption in the production process. Correct? For example, we have kept raw material with us. We know that during the production process, this raw material will be consumed. Correct? Not only in the production process or what we call in the rendering of the what we call services, these things will get consumed. Even these are what we call inventories. You must have seen that inventories have three elements. One, finished goods. Second, work in progress, and third one you have just seen, actually the raw materials. All these three things, finished goods, work in progress and inventories, are vital to understand. So these are the three main ingredients of as far as what we call inventories are concerned. You need to be very well familiar with this. Once you have done that, now we come over to another important point, that is the sixth point, initial recording of the inventory. You and I both are very well familiar again with this particular fact that initial recording as far as is concerned, that is done at cost. You know the meaning of the cost also, although I have written it. Cost basically comprises of purchase of what we call inventories, might be raw material, work in progress, correct? So purchase price, and if you have paid any taxes, duties, then of course you are going to add it. Similarly, if you have incurred any expenses in bringing the what we call inventories to your present location or condition, for example, you have incurred expenses in the form of freight or carriage, then such expenses too will be added. However, there are some elements which are going to reduce the cost of the inventory. So in order to know the cost price of the inventory, we need to subtract what we call trade discount. Suppose we have given a very heavy order, we might get some volume, what we call discount. So if we have received any trade discount, it will be subtracted. Similarly, if we have received any duty drawbacks means suppose I have imported the goods, the government has withdrawn the duty, so it is a benefit for me, my cost will get reduced. Similarly, nowadays GST is prevalent and we get tax credit also. So if we have earned any tax credit or refunds, such things will be subtracted. So that is how you are going to determine the cost. Correct? That is what we call initial recording. Initial recording of the inventory is always done at cost without an iota of doubt. Then we come over to the final recording. Final recording is very vital. I have already told you there are three what we call main ingredients of the inventory. One happens to be finished goods, another one happens to be work in progress, then is raw material. Correct? We also know the general rule. At the time of finalization of accounts, inventory is generally carried at lower of cost or net realizable value. However, that is not sufficient. We need to have a good look over all the three ingredients. Finished goods, the rule remains same. Of course, finished goods, remaining units of finished goods at the time of finalization of accounts will be what we call carried at lower of cost or NRV. Now, what exactly the NRV is? NRV is expected selling price less expected selling cost. Suppose if I am expecting that these inventories can be sold for 1 lakh, but at the same time I might have to incur 10,000 worth of what we call expenses in the form of sales commission, etc. Then NRV will be 1 lakh minus 10,000, 90,000. So in case of finished goods, NRV is computed by subtracting the what we call expected selling cost from the expected selling price. Of course, the general rule will remain same and intact, that finished goods will be carried at the time of finalization of accounts in the financials at lower of what we call cost or NRV, but you need to take care of NRV. Similarly, we come over to now work in progress. You have seen actually work in progress. That means these are the assets which are in the process of the production. Because these assets are still in the process of the production, that means they are not yet completed. At the time of finalization of account, general rule will remain here same, that work in progress too shall be reflected in the financials at lower of what we call cost or NRV. But while computing NRV, you need to exercise caution. Caution in the sense that while computing NRV in case of work in progress, from the expected selling price, not only selling cost will have to be subtracted, but you will also have to subtract the what we call, as I said, conversion cost. The conversion cost is very simple because these goods are still in the process of production. Unless and until they will be converted into finished stock, they cannot be sold out. So obviously we may have to actually incur some conversion costs. So while computing NRV, in case of work in progress, we need to exercise caution, because in case of work in progress, NRV will be computed or arrived at after subtracting what we call conversion cost over here. This is the raw material, correct? Raw material. While valuing the raw material, pay attention. Suppose there are some remaining units of the raw material. First of all, what amount will be carried in the financial statement at the time of finalization of account, at what value I am going to carry raw material in the financial statement. Here I am not going to apply the general rule cost or NRV. Cost or NRV holds true only with respect to finished goods and only with respect to, as I say, work in progress. In case of raw material, you have to be a little bit more what we call cautious in the sense because their valuation, especially at the time of finalization of account, is not an easy task, correct? So at what value raw material will be carried, first of all, we will have to see where these raw material are going to be used or where they are going to be incorporated, correct? Let us say these raw material are going to be incorporated in the finished goods, correct? Obviously, the raw material are ultimately going to be incorporated in the finished goods, correct? Raw materials are going to be incorporated in the finished goods. Then I will check the cost price of the finished goods and the selling price of the finished goods. I will compare these two things. Then only I will be able to know at what value raw material will be carried in the books. The general rule is that carrying amount of raw material is determined on the basis of the fact that where these raw material are going to be incorporated, correct? Obviously, the raw material are going to be incorporated in the finished goods. Then we will check the selling price and the cost of the finished goods to determine the value of the raw material. That means in order to know the value of the raw material at the time of the finalization of the accounts, correct, the remaining inventory of the raw material, at what value those raw material, remaining units of raw material will be carried, it depends upon the what we call selling price and cost price of the finished goods where these raw materials are going to be incorporated. Now the first rule is that if the selling price of the finished goods is more than the cost price, if the selling price of the finished goods is more than the cost price of the finished goods, then raw material, the remaining units of the raw material shall be valued at cost, that is cost of raw material. Is it clear to you? However, if the selling price of the finished goods is lesser than the cost, then remaining units of the raw material shall be valued at replacement cost. Is it clear to you? So this is what exactly we have written. If the selling price of the finished goods exceeds the cost of the finished goods, then the remaining units of the raw material shall be valued at cost. However, if the selling price of the finished goods is less than the cost of the finished goods, then the remaining units of the raw material shall be valued at replacement cost of raw material. Is it clear to you? And in order to comprehend this particular point, I have given you a case study also. See here, raw material is purchased, let us say, at the rate of 100 per kg. We bought some quantity of raw material. Quantity right now is not given to you, but whatever quantity you bought it at 100 per kg. Prices of raw material is on the decline. You bought it for 100 per kg, but it is given that the price of the raw material is declining in the market. Whatever might be reason, we are least concerned with those. The finished goods, pay attention towards this particular line. Obviously, the raw materials are going to be incorporated in the finished goods, no doubt about that. The finished goods in which raw material are to be incorporated, this is incorporated, correct? The finished goods in which raw materials are going to be incorporated is expected to be incorporated in the finished goods, but the selling price of the finished goods is less than the cost, correct? Further, the question states that 10,000 kg of raw material is in the stock at the year end. And it is also given that cost is 80 per kg if raw material is bought today. If I am going to buy the raw material today, instead of 100, I am going to churn out only rupees 80. In fact, this is nothing but the replacement cost, correct? Replacement cost means is the cost which you would incur in buying the same thing today, correct? Keeping into account all these facets, now see here, we know that these raw materials are being incorporated in the finished goods. We have been given that selling price is below the cost. And just a moment ago I said, if the selling price of the finished goods wherein these raw material are going to be used, if the selling price of the finished goods where these raw material are going to be used happens to be lower than the cost price, then the valuation of remaining units of raw material will be done at replacement cost, replacement cost. Correct? This is what I have written. Valuation of 10,000 kg of remaining raw material. Now, remaining raw material is 10,000 kg. and we know that replacement cost is 80. So 8 lakh ultimately will be the value at which we are going to reflect what we call closing inventory of raw material. So in case of raw material, we need to exercise caution. It's not an easy task, correct? So actually, I wrote till up to this particular point earlier, but I forgot to switch on my mic. That is the problem. So now we will take up more case studies, correct? Now case study 2 we are going to take. This is case study 2. Now in this case study, now please write, correct? Some students are telling, sir, you better actually read from the books directly. No, that is not the what we call my cup of coffee. I always believe in more you write, more you get what we call an idea. So let me think of a case first, then only I will begin. Allow me a minute or so because we have to recapitulate the things. Okay, right, F7 Limited. Pretty long question, it takes time to recapitulate. F7 Limited manufactures. No, I'm framing it by myself. F7 Limited manufactures finished product Y, wherein raw material X is used. So raw material X is used or is incorporated in finished product Y. That is the point which you need to understand, correct? Now we move further. Just let me settle the sheets, correct? Sometimes shadows come down, then it becomes a problem. Well, is used. Then write, calculate the value of raw material. Calculate the value of raw material and finished goods on the basis of. So question has asked to compute not only the value of the raw material but also of finished goods on the basis of the following information. On the basis of following information. On the basis of following information. Some information is delivered to you, correct? That is with respect to raw material X. Some information is given, raw material X. The information is like this, closing balance. So closing balance of raw material X is 500 units. So 500 units of raw material X are in hand at the end of the year, it means, correct? Then let me write cost including taxes and duties. So cost including taxes and duties, that is rupees 200. Rupees 200 per unit. 1 unit of raw material, correct, is costing rupees 200 per unit. Pay attention towards this. Then tax credit. You have got some tax credit. So tax credit will be subtracted. Freight inward. Now freight inward, say, is rupees 20 per unit. unloading charges. All these are expenses which are incurred in bringing the what we call inventory to its present location. Unloading charges. Unloading charges, let us say rupees 10 per unit. Then I write replacement cost. If I am going to buy these raw material today, replacement cost, then I might have to incur only rupees 150 per unit, correct? 150 per unit. This is the information with respect to raw material. It's an interesting question, pay attention. And finished goods. Information with respect to finished goods is like this. Same information almost. Closing balance. Now closing balance given to you is, let's say, 1,200 units. 1,200 units, correct? Material consumed. That means raw material cost is given to you 220. You want to say, okay, I will write 220. Some student down over here are telling me, sir, write 220. I accept it. Okay, you tell me, direct labor cost 10, 60, okay, 60 per unit. No, don't write 600 per unit. Material cost is 220 and you want me to write 600 per unit. That looks pretty awkward. Okay. Say something which is genuine. Direct overheads. Direct overheads. Yes, okay, 40, I will accept. So you told me 40 per unit, correct? So these are the costs given by the student sitting down over here itself, and my sheet is over, so I will have to move over to the next part. Write along with me, total fixed overheads. Total fixed overheads for the year. Total fixed overheads for the year were rupees 2 lakhs. Were rupees 2 lakhs on normal capacity, on normal capacity of 20,000 units. So when this entity operates at normal capacity, total fixed overheads are actually 2 lakhs, correct? Now my question to you is, in fact, I have already asked you the question. Calculate, I have already written, I think. Right, calculate the value of the raw material and the finished goods, correct? Now, how to do this? It is not an easy task. Pay attention here. So, here is the solution. First, A. Let me do the valuation of closing stock of Y. That is finished goods. Valuation of closing stock of Y. Remember, Y is the finished goods, correct? So we are doing the valuation of closing stock of finished goods. In order to value the closing stock or the remaining units of finished goods which happens to be finished, because it is given to us that Y is the finished goods. In fact, what I was trying to tell you, we are valuing the closing stock of finished goods. So we need to know the cost and of course the NRV, correct? And the lower between the two will be considered for the what we call valuation. So first of all, what I do, I simply compute the cost. What is the cost of finished goods Y? Remember one thing, we have been given per unit cost. Per unit cost, that is in rupees. We have been given material cost, material consumed. So material cost, we have been given 220, I think so, right, 220 per unit, of course. Then direct labor was there. Do you remember? Direct labor. You told me direct labor 60, in fact. And what was the other cost? Direct overheads. Direct overheads. Direct overheads were 40 per unit. Now, we will take into account fixed overheads. Now, question has given that total fixed overheads are rupees 2 lakhs. When 20,000 units are normally produced, so that means fixed overheads, which is always absorbed on the basis of normal capacity production. So we may now arrive at what we call per unit cost of fixed overheads, that will be equal to 10. So fixed overheads will be allocated at the rate of 10 per unit. This will deliver me the cost per unit of finished product Y, that happens to be 330. Right, it is. So 330 is the per unit cost of what we call finished goods Y, correct? Now suppose NRV is, I will write in the question itself later on. Anyway, suppose NRV is 400 per unit. Suppose NRV is 400 per unit. This I am imaginarily taking, correct? Then I am going to take the lower value out of these two to value the what we call closing stock of, as I said, finished product Y. So value of remaining inventory, value of remaining 1,200 units shall be at the rate of 330, shall be at the rate of rupees 330, correct? So because out of these two, lower value will be considered, so valuation of finished goods as far as is concerned, closing inventory shall be valued at 3,96,000. In fact, shall be carried in the books at 3,96,000. Besides, we have been also asked to compute the what we call value of, as I said, raw material. So valuation of closing stock of, valuation of closing stock of raw material, correct? I have already told you, valuation of raw material, valuation of raw material, I have already told you, depends upon finished products in which they are going to be incorporated. So valuation of raw material depends upon cost and selling price of finished goods wherein raw materials are incorporated Now just have a look. These raw materials are being incorporated in finished goods. Why? Finished goods Y. So we have to take into account the cost of finished product Y. Cost we know is 330. NRV is nothing but selling price. NRV simply reflects selling price because this is the value which we would get if we were to sell what we call all the units of what we call finished goods. So NRV is nothing, net realizable value is nothing but your selling price. So don't waste your time in searching out selling price, correct? So selling price is 400. So we can say cost is lower. Cost of finished goods is lower in comparison to their what we call selling price. Since cost is less, since cost is less than selling price, of course, of finished goods, where these raw material are being incorporated. Since cost is less than selling price, comma, raw material, remaining units of raw material, remaining units of raw material, remaining units of the raw material shall be valued at replacement cost. Now replacement cost is given to you in the question, correct? Replacement cost is given to you in the question. If you look into the question, you will find that the replacement cost is actually at the rate of 150. So closing inventory of raw material will be closing inventory of raw material will be 500 remaining units into replacement cost rupees 150. That will be equal to 75,000. I think so. Is it clear to you? This is how you are going to actually do, because many questions have been asked out of this particular topic, especially the valuation of raw material, so you need to be very, very deft in it. Try to do this particular case study by yourself. On 31/3/21, there is work in progress of product A. It is estimated it is estimated that finished product can be sold at rupees 1000. Estimated cost of completion is rupees 200. And brokerage of 10% on selling price is to be incurred. Compute NRV of work in progress. So question has simply asked you to compute the NRV of work in progress. First of all, you must understand here that there is some work in progress. There is some work in progress of product A. Now ultimately this work in progress will be converted into finished goods, no doubt about that. But here we are not talking about raw material, we are talking about work in progress. Now the point here is that in order to turn it into finished goods, we may have to incur a conversion cost of 200. This is what exactly is given. Estimated cost of completion is 200. So I hope now you got the point actually which I am trying to tell you. So while computing NRV, in case of what we call work in progress, we will write the what we call selling price, estimated selling price, which is given ESP, estimated selling price is 1000. It is given to you, estimated selling price. And from here on, we are going to subtract, as I said, conversion cost. Now conversion cost is 200, we are going to subtract 200 besides brokerage, because this is selling cost. Brokerage will be 10% of 1000. So 100 rupees further we may have to subtract. So NRV will be equal to how much? NRV will be equal to 700. NRV will be equal to 700. Is it clear to you or not? Case study 4. Okay, right. FX manufactures 3 products. With X, Y, and Z. Correct? At the year end, at the year end, unsold amount of X, Y and Z is rupees 5,000, correct? Similarly, 8,000 for Y, it means, and 2,000 respectively. I also write NRV of X, Y and Z is rupees 4,500, rupees 7,800 and rupees 2,500 respectively. Now my question is, compute the closing inventory. Compute the closing inventory. Compute the closing inventory. So we are supposed to now compute the closing inventory, which you can do it very, very easily, correct? But just a point or two, correct? Just a point or two I would love to actually mention here before we wrap up. First, let me actually put up a chart. Product, 3 products are being manufactured, X, Y and Z. It is given that at the end of the year, some of the units of these products might have remained, but what is given to us, not the units, which is given to us is their amount. So cost which is given to us is 5,000, then 8,000, then 15, then 2,000. Then we have been given NRV. NRV given to us is 4,500. Then it is given to us as 7,800. And we have been given 2,500. Point here is that we might attempt to compute closing inventory this way. Suppose if I add, then the total cost will become 15,000 of the remaining inventory of these 3 products, and total NRV if I compute, it will be equal to 14,800, correct? Now it is a case of finished product, correct? No doubt about that. Finished products at the time of finalization of account is carried at lower of cost in what we call NRV. So it could be a possibility that we might give the answer 14,800, but it will be wrong because we did not go by the what we call guidelines of the standard. The standard says that valuation of the inventory should not be on global basis. This is the approach known as global basis. Global basis means you have combined the cost of all the what we call inventories. So you should not adopt this approach, rather you should go by individual approach. So individual approach means now at what value I will reflect, I will take individual basis valuation. So out of these two, lower value is 4,000. Individual basis I will take into account. Then similarly 7,800, and out of these two, lower value is 2,000. So this is the value 14,700 which will be reflected in the books. Are you getting my point or not? Let me write also, which I just told a moment ago. Valuation of inventories should be on individual basis. Individual basis, that is item by item basis. Item by item basis, correct? And I have already told you, and I will write it here also, inventory shall be reflected carried at rupees 14,700. Correct? Anyway, so we'll continue with this in the upcoming session.